much for joining us. For those who don't know me, my name's Richard Betts. I'm the publisher at Real Asset Media. We produce Real Asset Insight. We launched Real Asset Impact, which is specifically around ESG, social impact strategies. We do things like the Expo Day Daily News and a number of sort of initiatives like the Senior Housing and Healthcare Association, as well as both at MIPIM and Expo Real running dedicated programs there. So a lot of focus around sort of, I guess, working with the industry. And although we cover the news, and we have our Paul, our news journalist, here with us today to cover the news, actually a lot of what we're doing is sharing insight, research and strategy, and the sort of things that may be then driving the headlines in the next months, rather than focus on exactly what's happening deal by deal. This morning, super panel. But I'm first of all just going to hand us over to Andrew here from Savills. And Andrew's just going to give us a kind of quick, I guess, race through some of the key facts and figures, some of the trends that we're seeing.
Great, so just as by way of introduction, my name's Andrew Blennerhassett. Difficult name to spell, difficult name to pronounce. I've just come over from the Irish team, having worked there for 3 years in cross-sector, and I'm now I've just joined the UK and EMEA industrial and logistics team in Savills, so covering most major real estate assets, typically over 100,000 square feet. So what I'm going to present to you today is I'm going to take you through basically an overlook of the economy, an overlook of our recent logistics survey, which basically covered about 400 companies, about 25%, or 400 respondents, about 25% of which were occupiers, which is quite helpful for us. And then I'm going to go into the occupier market before having a look at the investment market. And basically, as you say, I'm just going to try and set the scene. So what we're currently seeing is a lot of kind of conflicting headwinds and a lot of conflicting signals. But we have seen so far this year is that we're about 2% ahead of 2021 in terms of occupier take-up, with about 29 million square feet taken up. And similarly, the investment market has done quite well this year, with about 42 billion in total in investment flows into real estate assets, logistics real estate assets. And again, just about 2% ahead of those record years in 2021. The crucial thing to keep in mind, obviously, is that logistics saw a massive boom during 2020 and 2021 due to the e-commerce boom, and that has continued to kind of push into H1 2022. In the short term, what we've seen, obviously, is I can't go a single day without talking about inflation these days. But what we've seen is inflation in the Eurozone, the US and the UK looks to have started to peak in the US. Seems to be slowing in the UK. It's expected to start slowing and peaking in the UK and the Euro area in the next few quarters. And what that means is what we're seeing here, and what we've seen here is a sharp response in terms of policy from both the US and the UK, with slightly slower response from the Euro area in terms of interest rate hikes. That's obviously because when we look at what's actually driving these changes in prices and driving inflation, a lot of what's happening in the US, for example, is driven by a hot labour market, whereas in the EU, what you're seeing is a lot of issues around energy prices driven by the invasion of Ukraine. How is that affecting things? That is obviously when we raise interest rates to work on to deflate to call it in a deflationary manner. What we see is that growth tends to slow. And that turns in terms of consumption, in terms of spending, and especially, and that will have a negative impact on the logistics market. So what we've seen as prices have risen is we've seen a sharp drop in consumer confidence. That's in dark blue at the bottom on the far right hand side. Similarly, you can see in the purple, we can see that the GDP has also fallen. But interestingly, in terms of the logistics market, what we're noticing is that retail sales have not seen a particularly sharp dip, especially when we compare to what we see during the COVID pandemic. We can see quite an outsized effect, whereas currently it's been quite slow to respond. And what that basically shows us, and what we're seeing in the current economic forecast, so this is from Oxford Economics, we can see in terms of dark blue, we've got consumer spending, and in teal, we have employment. And obviously, these are both very important factors for logistics, because when it comes to the flow of goods through the economy, consumer spending will obviously dictate that, and employment will obviously have an outsized effect on both consumer confidence and also their ability to spend. So what we're actually seeing is contrary. So if we look at, say, the global financial crisis, we had quite a sharp fall. Whereas if we look today, 2023, next year, we're seeing about a 0.3% decline in employment, with consumption spending actually only slowing in terms of growth, but not actually declining. And that's very positive. So I'm just going to quickly run through what we're seeing in terms of occupier sentiment now. And it's quite interesting. So what we've seen is, in dark blue is what we've seen in 2022, and in teal, again, 2021. So in 2021, what most occupiers were quite concerned about kind of developed around online sales, and that moved towards e-commerce. And so you can see that in terms of increased customer demand for delivery, just in here, as well as availability for warehouse space. Typically speaking, warehousing or the logistics requirements for e-commerce is about 3 times as intensive for logistics. And what that basically means is, for e-commerce, and what that is there's a lot more need for a wider variety of stock. There's a lot need more for processing of returns, and so that obviously was what was driving our occupiers in previous years. But what we're now seeing in 2022 is there's been a sharp change here, and what we're now seeing is this rising costs is now up at about 60% of respondents are much more concerned about that. Similarly, availability of labour and economic uncertainty has risen to the fore in terms of what's actually affecting occupiers. Crucially, however, what we have seen from the supply chain crisis, which has been one of the big issues in the last year, is that occupiers have moved away from a just-in-time model whereby they bring in stock at the last possible moment to deliver it, thereby minimising their inventories. And what they're now looking to do is actually try to increase the level of inventory they hold, trying to mitigate against supply chain issues such as what we're seeing in China in terms of lockdowns, such as what we've seen in the shipping industries. And what we're now seeing is about 38% of respondents are looking to increase the quantity of stock they've held. Another 31% are to go to diversify their supply chain. And what's really been interesting is this reshoring, nearshoring effect, where about 28% of respondents are looking to actually bring their supply chains closer to their end markets. And that is going to have that will have a very positive effect for the industrial occupation market or the logistics occupational market, because what we will be seeing is an increase in actual footprints, or at very least support for occupier footprints. And that's what we're seeing here, is when we look at how many occupiers look to take up space or increase their footprint or remain at the same level, about 90% expect to remain at the same level or increase space in the next year. And that's obviously very positive, especially as we go into a slightly more turbulent period. And just to kind of demonstrate that effect, so what we're looking at here is overall inventory levels across Europe. And we can see that this 4-quarter moving average, just to remove out any seasonality so that we're getting just pure like where things are at, we can see that they have absolutely spiked in terms of how much inventory occupiers are holding to a decades high. And that will inevitably have a positive impact on the occupier market. So what have we seen in the European occupier market this year? So these have taken from our European Logistics Outlook. We've just published it a lot this week, so would really recommend you all read it, mostly because I wrote it. So we've seen about 29 million square feet of space taken this year. That's up about 2% compared to last year's record year, and about 28% ahead of the 5-year average. But what we're seeing, and as you can see in this year, we can see a steady decline in the last three bars. And what that is we had an absolutely standout H1, and then Q3 started to slow down a bit. And so that's what we're seeing here, is overall looking at this in this red, you can see that things have started to dip slightly in terms of the quarter-on-quarter and the year-on-year, whilst remaining just ahead of the 5-year average for a Q3. So much now depends on what we see in Q4, how occupiers continue to react. One of the biggest two losers, or some of the biggest losers at the moment, have been Denmark, France, and the UK. But at the same time, we've seen other areas like Romania, Ireland, and Hungary seeing strong increases in take-up on a year-on-year rate. How has that played out in terms of the occupier market? Well, what we're seeing is that the vacancy rate has continued to decline. We're now sitting at about 2.93% in terms of overall vacancy across the whole of Europe, and that's, again, so that is for logistics boxes over 100,000 square feet. And that's incredibly positive, because what we found in the UK is that when vacancy is below 12%, rents have never fallen. And so given that, what we can say is there's a lot of room to maneuver in the logistics market right now. There's a lot of space for stock to come back onto the market without having a massively negative effect on rental growth. And that's what we're seeing here. And this is Capital Economics economic forecasts. And what these forecasts look at is they look much more at an economic, take a much more economic view of how these things are working. So they're looking more at that consumer spending. They're looking more at those employment forecasts. And when we say, look, where we have it here, what we're looking at about just under 2% rental growth year on year. But that's not what we're seeing. Pardon me, I'm just going to jump onto this one. That's not what we're actually seeing. Is if we look at in yellow, you've got year on year, and we can see strong growth across most of the European Union, or most of our European markets. Yellow, you can see about 38% year on year in Paris, 36% in Prague, coming down again. Poland 18%, Dublin 7%. Schiphol 6%. So what we're seeing is strong growth in terms of prime rents, which contradicts what we're seeing from this more economic-based forecast. Because what's really driving rents at the moment is that critical and chronic lack of supply. And just to kind of demonstrate it here, so what we see is when in the solid bars we have vacancy rates for Prague and London, and in the dotted lines we have our prime rents. What we can see is a clear takeoff in rents as vacancy rates start to decline further. And that shows just how important this impact is as more occupiers compete for less space that drives prime rents. And which in the inverse, in a downturn, given this chronic lack of supply of rent, we would expect that to continue to provide some support for rental growth. In terms of the logistics market, logistics has had a very strong period during the pandemic and after, as a lot of investors have started to move it more towards a kind of core asset strategy and away from where it previously would have been in a more alternative strategy. And so what we've seen is about 42 billion up about 2% from our previous record-breaking year into 2021. What we would say is Q4 is unlikely to be of the same strength. And as I will discuss in the next slide, the reason for this is that as things stand, we are seeing a divergence in terms of the expectations of vendors and the expectations of buyers. Rising interest rates has obviously massively increased the cost of debt. And what this means is if you're a leveraged or a debt-based buyer, a lot of assets are now outside of your price range. And if you're a cash buyer, there's a strong impetus to wait and see how the market shakes out. So what we've seen a fairly dramatic shift in yields in some areas. So especially, I think it's the UK, where we've dropped from about 5% where we've risen from 3.25% to about 5% in terms of yields. But crucially, I think, yes, we've only really seen about an increase of about 50 basis points, 57, or from 5.04% in Q3 2019. If we, if we consider where we were prior to the pandemic, we were looking at about 5.5% in terms of yields, 0.4% in 2019. So we're still well ahead of where we were pre-pandemic. So it is definitely still a very strong market and it's still in a very strong position heading into 2023. And that's it has been incredibly positive when we move into, as I say, quite an economically uncertain point. Occupier demand has started to normalise, but there's a low vacancy rate across Europe, and that should help to keep that market in equilibrium. We know that occupiers are concerned about rising costs, but crucially, they're also concerned about keeping their supply chains as safe and as robust as possible. And price discovery, hearing it a lot at the moment, but it remains elusive, and it will probably start to actually shake out in Q1 2023 and beyond. But that's everything from me. Thank you very much.
Great, thanks very much, Andrew. So, Andrew, you can grab a seat there if you wish. That's fine. Thanks very much for that. Really interesting. So, if the speakers could come up now, that would be great. Really interesting. Lots of things I think that we can pick up there in the discussion. And certainly a number of those things we picked up. I'll just let you know as well that that Logan, who is here from Amsterdam, and I learnt that he was coming yesterday, and I cajoled him to come onto the panel to share his views, despite the fact that he has something at 9 o'clock which he can't avoid, and will nip out and come back in again. So we'll all pretend that doesn't happen when it does. Good. Let's just start with introductions. Maybe let's start with you, Logan, and then we'll work our way down. So just a really brief kind of 30 seconds on who you are and what you do. Logan.
Sure. Thanks, Richard. I oversee logistics for Hines, a diversified asset manager. We acquire assets through a number of discretionary funds that we have and through separate accounts. We are also getting to be one of the larger developers in Europe as well. We are operating across really most countries in Europe, and we have the opportunity to really work with some great colleagues and country teams, and appreciate the opportunity to be here. Thank you, Richard.
Perfect. Andrew.
Hi again. Andrew Blennerhassett, working for Savills in real estate, European logistics. You may have noticed based off my presentation, but I'll let everyone else introduce themselves.
Perfect. Andy.
Okay, Andy Crichton. Good morning, everybody. I'm from Cromwell Property Group. I'm the new boy in town. Actually, I've only been there less than 6 months as head of investment management for Europe. I spent 10 years at Aberdeen and a similar time at Henderson Global Investors. So that is me in a nutshell.
Perfect. Joost.
Joost Deenitse, Verisol. Several years busy in this market. What we do, we enhance your yield of your logistics by decarbonization.
Great. Perfect. Will.
Will Purr, DHL Supply Chain, the head of UK and European capital markets for that side of the business. So ultimately the development arm of the supply chain business of DHL, building out green buildings for our occupational needs across the European platform.
Perfect. Chris.
Hi, morning everyone. I'm Chris Turley, partner of Taylor Wessing. I think Paul gave you the introduction on Taylor Wessing. Personally, advising a number of investors, private equity, institutional investors, occupiers, and occasionally some developers. So seeing the spectrum across in the logistics field.
Great. So a really interesting set of different perspectives coming from across the market. And very glad you could also make it over from Holland, Joost, as well, because I think that sustainability part of it is one of those key trends for 2023 and we've seen in 2022. Logan, maybe just picking up with you first. I guess before looking at the outlook for 2023, huge changes in 2022. How do you see those? Are we able to get a perspective on them, I suppose? What are some of the key aspects for you looking at logistics across Europe?
Yeah, and I think, Andrew, you did a fantastic job in outlining this. So other than echoing what my fellow panelist here just got through explaining, and I said that only half jokingly because I think you touched on some of the really key things that we're seeing. Number one, in spite of it all, the occupational market is still relatively quite strong. And by relatively, I think we mean compared to a 5-year average. Obviously, things are softer for logistics. Every single asset class on planet Earth has repriced over the last 3 to 6 months. Logistics, of course, is no exception. But when you look at what's happening, there are still, fundamentally, it's still driven by occupiers who need space. And one of the points you put on there too, in terms of the of where we see inflation versus where we see market rental growth, I'm a little shocked in a sense that we've seen the market rental growth that we have over the past couple of years. A couple of the markets that you had mentioned in terms of where we are seeing the weakest absorption, such as Paris, for example, in fact, are the ones where you've seen the highest market rental growth. So there really is a supply side of this story that is underpinning this whole story from the occupational standpoint. On the investment side, yes, of course, everyone's debt is more expensive in logistics as it is everywhere else in the world. Of course, it's more difficult to underwrite exit cap rates, but there's still a lot of capital that's interested in logistics. And of all of the sectors within commercial real estate, or even non-traded REITs, or really almost any investable asset class right now, this is one sector where we still have a relatively strong tenant demand and there's still a lot of equity to go. So I think that we haven't seen a lot of transactions this year. And I don't think repricing is going to happen anytime soon. But the fact is, there's still a little bit of liquidity in this market. It's not as good as it was, but certainly better than most other asset classes, in my view.
I mean, that's interesting. And Andy, from your point of view, are you still seeing the same level of interest in terms of capital, institutional capital, looking at the sector?
Yes, I mean, there is a huge amount of capital trying to get into real estate generally. The favoured asset class remains logistics. I think you'd have to premise that slightly in terms of private equity money trying to get into the marketplace. Again, they're building up their reserves, but of course, generally that source of equity normally staples debt onto what they're trying to do, and obviously that's been challenged in the last 6 months. So they're sort of standing ready, waiting for a bit more shock in the marketplace, but we're still seeing interest from institutional capital in different places across Europe, and we'll probably come on and talk about that. But demand remains. I mean, some of those dynamics, when you look at the supply-demand dynamics, it's too out of kilter, and rents still look very affordable. So, that is attractive.
And is there room in areas like, it was interesting that it was much more optimistic, the session that we did in Paris, than it was in Germany, for example, when we did one in Frankfurt. And logistics especially coming through in the French one yesterday. Do you think that those sorts of rental increases can hold? Do you think there really is that potential in the market there?
Well, when you look at actually the percentage of occupational cost which goes to rent, it is still very, very limited. Labour is the number one, and that is very stressed at the moment. So actually, of course, and then energy costs, and then you've got inflation and general cost inflation across all areas. But as a percentage, the rent piece is tiny and is still very affordable. So I think that the short answer is yes.
Okay, good. I wanted to pick up a little bit with you, Will, and I'll come to you in a second, Joost. But obviously, you're looking at it from a slightly different perspective from DHL. So I guess over 2022, what have been some of the key drivers for you? And I guess how do you expect to see those moving into 2023?
So there's two parts to that. There's our own internal drivers, which are from the highest levels, the drive for getting our occupational footprint into carbon neutral ESG CRREM compliant buildings across all of our geographies. In terms of the actual demand side of things, there is, it's all the points touched on in the presentation, there are still many drivers that are still finding their equilibrium in terms of the rebalancing of the nearshoring. It was only a small part of the percentages, but the people shifting towards 3PLs, mid-cap companies are looking at that in a cost-conscious environment to say, actually, we can have more flexibility around that. So that is increasing. We are, though, still seeing parties now at the back end of 22. Maybe that's to do with the time of year, Christmas, and people not wanting to detract from their peak sales times, but a few people are pausing just to see where the outlook lies. We're not the only people who are experiencing increased cost of debt. Corporate debt has done the same, so there are a balance of equations here, but fundamentally there is still a robust pipeline for us in terms of client base, and it's just a case of now commercialising and making viable the green buildings, and that comes from the desire from investors to actually have that as a key criteria for them in what they're wanting to buy. And there's still a gap there in some geographies, depending where the capital comes from, but fundamentally it's clearly becoming more, especially in the UK and Europe, more front and centre, having those green buildings.
Okay, good. And I'm going to touch on that in a minute. Just in terms of the market here, Chris, do you see that we're beginning to stabilise in terms of values? Are people still a little bit scared that they're going to catch a falling knife if they're thinking about buying now? Andrew mentioned there that, some of the available capital, the equity, is waiting to see, and obviously some of the capital is out that was using debt before. I suppose, what's your sense of that? What are you seeing in terms of deals beginning to come through across your desk? What's your sense of where we are?
I think Andrew called it well again earlier when he said that we haven't yet reached the sort of the agreement between seller expectations and buyer expectations. And, we remain in this sort of period of sort of too late to sell, too early to buy. Now, I think that inevitably, we are seeing a narrowing of that. There is an extent to which you say investments will be done based on years, and so people will look at actually a strong start to the year, so the pressure to buy hasn't been there. Similarly, we've got the debt coming in. You'll continue to see a requirement on refinancing and other market pressures, which will perhaps create a little bit more force on the sell side. And we've heard it from quite a number of the panelists. The demand for investment and investment in logistics remains very, very strong.
No, I agree. I think it has been strong. Let's also pick up. And by the way, if you've got any questions, please do just raise your hand, shout them out, whatever is the best, in order to make sure that we do. Because part of the joy of us being here is that we can answer them. Let's just come to you, Joost, in terms of the ESG side, sustainability side. What have you seen in 2022? What do you expect to see again, I think, in terms of increased electrification, some of the impacts, I suppose, on the market, particularly here for logistics?
I think 2020 is the market is changing now. Earlier, all the companies doesn't take it as serious as they have to take it now. And I think in 2023 the market will see it as a special need for the building. You need to have it. And the occupier rates are still high, but what we see now is also a changing in demand of the occupiers. They also have to decarbonize, and they have to fit in a building what is net zero performance. Otherwise, they are not accountable anymore for their contracts to deliver. So the shift is now starting to happen. So you have to really think differently to your building. So all the old standards are shifting.
Okay, it'd be interesting, and we've all been terribly polite so far, but we are allowed to talk if I haven't asked you. So if you've got any perspectives to bring on any of these, do come in. But it'd be interesting to Chris, maybe just coming to you briefly. Are you seeing the drive more from the investor side, more from the occupier side? I mean, we've got DHL, obviously, very focused on this area, but are you seeing it more from the investors, more from the occupiers? What's your sense of that?
Well, I think if you look at it from the investment side, of course, it's famously it's the rebranded sector, isn't it? You go back quite a number of years and you had industrial, and that wasn't really featuring in the top criterion. It's if you can have a sector rebrand, the new logistics, it's very much it's one of the priority investment sectors for institutions and private equity across the globe. So the demand for exposure to the logistics market, people do very much see it as the future. I think you talk about the market now, that there is still very much a flight to quality. So when markets get tighter, I think the products that will sell well will be the prime locations. Will certainly attract it more. I think from the occupier side, you've seen Will be able to speak far more eloquently than I can. But you've seen people have had to look at supply chains, whether that's from retailers through to the other businesses who are looking at their supply chains, looking at improvements to that, looking at the different way in which you have to deliver logistics, which inevitably is leading to that greater demand. And I think across Europe, you'll see countries are at different stages of evolution of that, and there is also opportunity in that in the areas that perhaps slightly under-evolved.
Yeah, I'd just like to add to that your point there about the evolution and the different rates and speeds. That's consistent through the investor sphere, the occupier sphere, and it's changing rapidly. But we talk to some global corporates who the start of their process is driven by procurement. Ultimately, it comes down to cost. You put a green solution to them versus an existing building. Someone up high has to rattle the bell saying, actually, this is our key focus. That one is no longer viable. We can't even look at it. And we're still in that transition period there. And I think there's a risk of the costs associated with corporate debt, et cetera, coming through next year, that the decisions aren't as binary as they should be. That's the other side of why we're doing what we're doing in terms of the resilience of our green criteria. Fundamentally, we have a lot of planes, we have a lot of boats, trains. We have a lot of carbon created by so we're doing everything we can to rationalise that carbon footprint. That for someone without our scale to do is going to be a real challenge, which is, I suppose, why we're seeing a lot of people coming to us for those other 3PL solutions, not just the warehousing side of things, but it's feeding into that because they can see that it plugs into a green building as well as the battery-powered last mile delivery vehicles, the electric planes that we bought recently. We're trying to do everything we can to drive that, and including how we're looking at our buildings, which is the main focus, and that's the solar PV solutions, battery storage, everything we can going gasless, ground source air source heat pumps. It's still a very early process. Though it's a lot of discovery for us. So when we're talking about price discovery, there's a lot of ESG discovery and how that actually works out. So I think it's evolving constantly, and there is no consistency anywhere. Different businesses, different investors have different thresholds, and the benchmark hasn't sort of been set yet. It's getting there, but it's still not. I think we would have been there earlier had we not seen the economic turmoil that we've seen.
Richard, can I just? I'm sure we'll talk a lot more about ESG. Just the question that you asked, Chris, just in terms of catching the falling knife. And no investor is clever enough to know when the market has hit rock bottom. Some people like to pretend they can, but they can't. But it is relatively simple to work out when you are in that period, whether you're on the way down or whether you're on the way up of the last 10-15%. We've had, and so I'm going to be the prophet of joy here before Christmas, because we've talked about the strength of the marketplace, and I'm nervous to even mention it because I don't want other investors to dip their toes into the water right now, because the best deals that I ever did when I was doing pure fund management was coming out of the global financial crisis, when everybody else was too scared to get in and take some risk. And those are the best performing assets. Assets will only ever perform if you pay the right price on the way in. And I feel that that opportunity in certain markets where valuations and are more mark to market than in other places, there are opportunities. We've had a busier time in terms of assets coming to our investment committee in the last quarter than I think in the last 2 or 3 years.
And and at prices so the sellers are coming to you, and it's at prices. Is there a lot of chipping of pricing? Is there? I mean,
we have we have to act in the best interests of our clients. So real estate being real estate, there is time that elapses between when you agree something and when you ultimately sign on the dotted line. So. Of course, normally we would just have one investment committee at the start of the process. With the volatility, we have to do the right thing for our clients and review it at the end of a due diligence process. Sometimes that leads to further discussions, sometimes it doesn't. But that extra check is in there for sure, and you wouldn't be doing the right thing by your clients if you didn't.
Okay, good. And Andrew, it'd be interesting to pick up from you just in terms of how, from the research that you're doing, I suppose how you're seeing that sustainability part of it as well. Is that being driven by regulation? Is it being driven by occupier demand? Is it being driven by investors? What's your sense of that?
Yeah, I mean, I think it's quite an interesting space at the moment. Obviously, ESG is quite a nascent, not really sector, but like part to assets, I suppose, or trait. In terms of occupiers, it can be a little bit more difficult, but I mean, like when you talk about BREEAM, when you talk about LEED Gold, etc., there's always the question from the occupiers of, does this actually make my asset better performing in terms of energy? In terms of investors, we've definitely seen a marked change, and we're obviously careful about how we phrase it, but there's definitely like significantly more interest in those ESG rated assets because occupiers want them and because investors want them in terms of their own ESG credentials. How that, and then in terms of just some of that regulatory side, there's obviously a looming deadline in terms of when you will be able to use those assets or buy those assets or lease out those assets. And at a certain point, what we will potentially have to see is either those deadlines will have to be pushed back or substantial amounts or portions of stock are going to have to be retrofitted. And so that will, and at that point, when you look at that, it's going to be a case of what the already limited supply in the market is now going to be even more limited in terms of what is actually fit for use in terms of that ESG potential, and that will have a substantial effect in terms of the values and the rents that those assets can achieve.
And are we likely to see kind of, like we've talked about in other sectors, stranded assets because of this? And originally, if I'd have talked to people kind of 3, 4, 5 years ago, they'd have said, well, no, it's just a shed, isn't it, sitting there somewhere. So there's no capex that you'll have to put in. It's going to be fine for years and years and years. But is that true now or not true?
I think in terms of being able to retrofit these assets, it is possible. But the problem is increasingly, and I think it's been alluded to in this panel, labour is in a very short supply. And when we go into the labour that has the specialisation that can do these retrofits and can attain these certificates, that is shorter in supply again. And as we approach that deadline, those occupiers and those asset owners who haven't looked to a retrofit may find that they are going to struggle to find the resources they need to actually get their assets up to that level.
And Andy, maybe coming to you, just in terms of the investor point of view on that, I mean, are you looking at now very much the resilience of those assets in terms of sustainability, but also to a certain degree, we've seen the energy crisis in terms of resilience of energy as well?
Yeah, just on the first point, as you've gone through market cycles, ESG and its previous names under different guises has sort of raised its head, and as the market's improved, it sort of gets some coverage and then it's fallen off. I think we're now at a point where it is absolutely central to everybody's investment strategies. Our head of ESG has a seat in our investment committee, has exactly the same vote as anybody else on that investment committee. Of course, their focus is looking at the cash flow that's been put forward to ensure that it maintains those ESG credentials, both for the occupier, but obviously, as we think about, you're always looking at an exit strategy to make sure that it is keeping up with where it needs to be. So that is we've reached a point of no return, I think, as far as that is concerned. In terms of energy, I mean, we have a blanket requirement across every logistics unit that we manage on behalf of clients in terms of photovoltaic cells. Tenants have been pretty uninterested in talking to us for a period of time, but now, funnily enough, they are more than interested, and they're the ones knocking on our door than the other way around.
Yes, that's what I see.
So an increase in demand there, definitely. And how much is, for you there at DHL, how much is that sort of resilience in terms of energy supply now becoming more important? Because plainly, if you're in Germany and there's going to be power cuts at various points, or there's those kinds of things, that has a real impact on what goes on inside the warehouse.
Yeah, massively so. And one of the key factors in all our new buildings is gasless. Getting rid of the gas element for heating. And in order to do that, it's the ground source, air source heat pumps we talked about, which is another power requirement. They are, depending on the size and structure and volume of the building, they're quite a big power user. So your usual...
One third?
Yeah, exactly. So you've got a situation where your usual power requirements for any estate, building, whatever, it's going to be going up, not down. So although it's becoming more green, more efficient, you then have to find, okay, how do I provide that in locations where grids are under strain, so we have continuity and consistency of power, and that is PVs at the moment. That seems to be the front runner in terms of that solution, but some geographies you therefore need a battery storage solution, because frankly you only have light for so much of the day, and so you need to be able to have that resilience. And you have a grey day in the UK, you don't generate that much power. So the technology is catching up. We're doing a lot of work with solid state batteries and battery storage. We're not there yet, but frankly that's one of our key pieces is power resilience, especially when you've touched on it, or someone's touched on it previously about the automation side of things, which hasn't, like everything, has had the cost inflation factored onto it. But there's an issue that is quite power hungry at times as well, and the same resilience is required there. Otherwise, you functionally have a redundant building.
But can I ask you another thing? Power resilience is only one, but what do you think of the valuation of the building because mostly to greenize or to get your ESG credentials, you have to buy green power.
Yes.
The procurement.
Yes.
Where you not can produce it.
Yeah.
So we are going to electrify it more and more. I think we have to double the amount of electrification, and also everything needs to be green energy. So you have power resilience, but I think the dependency or independency of procurement of green power is getting more and more.
Oh, we
Impact on the valuation of the building.
We only have that. We only do green power in our contracts across Europe, well, globally actually. So yeah, we've got a large procurement team just sourcing green power for us. So yeah, completely agree. But it's just then, again, availability of that green power in some geographies isn't there yet to the volume you need. So there's going to be a competition for that green power supply.
So the price will rise.
Which is, again, the reason for trying to create the resilience.
Exactly.
Yeah, so it's a nice cycle going round. But.
And just in terms of the that sustainability side, because does having photovoltaic cells on the roof and they're generating green power, does that also help the sustainability of the building or not? So do you get, so for example, if you've got an issue with something that may need additional capex in order to make it reach the right level, if you put photovoltaic or the cells on it and it's producing green energy, does that help you or not as the building owner, I wonder?
Well, yes, is the short answer in terms of, sustainability is now touching everything. And if you go back to, you've got the corporates, and whether those are Will's customers or whether it's DHL themselves, they'll have their own stated sustainability aims, and therefore suppliers, the underlying customers, will require that of DHL. Similarly, if you've got the direct tenants, they will have their own corporate things. Believe it or not, people even ask about lawyer sustainability. So you have sustainability and corporate responsibility sort of touching everything. You then have, on the investment side, which you asked about, you've got the raising of funds and people's expectations on, if you want to raise funds nowadays, again, you will have, whether it's institutional investors to those funds or whether it's even private investors, they'll be asking about the sustainability criteria of that. If you work back from that, in order to attract or be most attractive, you need to have sustainability at its forefront. Sorry if this is a rather long-winded way of saying that, therefore, in order that you can put those criteria on, PV is an obvious one because you can show in a brochure that you've got this. But actually, it is definitely something which makes an asset more attractive. But I think people do also need to look more broadly at sustainability in order to sort of truly making the difference. And this is, I think Andrew touched on it earlier about the sort of the lip service or certainly some movement towards sustainability and its impact versus the reality. And I think we're moving closer to, actually, it needs to be real. It can't just be a token gesture.
Can I just make one comment on that? You cannot, in our world of investment management, and you're looking at RFPs to win new business, you cannot proceed to the next stage if you do not have a full and proper response to the various questions that relate to sustainability. You'll get knocked out of any opportunity there. So I think that is absolutely critical. What was the other thing I was just going to say? I'll come back to that.
Just to add one thing in terms of the PV, the solutions, the approach, geographically, it can be quite a headache because legislation in different geographies, different countries, mean it's almost punitive to put it on the building. As a landlord, it's really understanding you have to be a power provider in some countries to be able to sell that power to your tenant. Otherwise, you're leasing the facilities. There's lots of mechanics and lots of things that make it not as easy as it should be for something that is so fundamental. But
sure.
Therefore, it's very so. This especially our
exactly
our part of the business.
Richard, just the other thing I was going to say was just I think we're absolutely at a tipping point with investors where if there is a fund that they are looking to invest in, are they prepared to forego return for the sustainability benefits of the product that they're about to invest into? And I think we're starting to see that. I think we're, I don't think we're there yet, but with a couple of products that we're launching at the moment, it's an office, it's a wooden buildings fund, which could be logistics actually. We're starting to see investors starting to think that they would be prepared to take a discount, for the benefits that the sustainability nature of the product would bring.
And there's an argument to say with that that's a short-term view, that actually, again, to the point of, is there going to be a green premium, then actually you might move into the other side of the sphere and actually be ahead of the curve and be beneficial and actually make the returns where the stuff that you've got as a legacy becomes a liability. So,
Or take it, the liquidity.
yeah.
In the future, the liquidity is important, and if it doesn't have the criteria, you've got a problem.
What was also good what you were saying is that, or what you're just saying is, everybody talks about BREEAM and extra. Now is it shift to decarbonization, but you see now also the new movement is deep decarbonization. And deep decarbonization is the premium where people are willing to pay, because on the end of the SFDR regulations, it will be a brief 9 fund, and 8 will also stop. So that's the real thing.
I mean, for sure, it's been interesting just to see how the changes in people's perspectives have changed dramatically over the last, I would say, 12 months and maybe even 6 months in a way, in terms of the importance of what they're needing to do and an acceptance that there will be costs related to that, but that they are costs that are worth paying. Because in the medium term, you're going to be beneficial. Or if you don't do that, you won't be able to sell that asset. You won't be able to let that asset. And so therefore it becomes worthless to a certain degree. And Andy, just in terms of your portfolio, how are you doing that at the moment? Is it something where you're actively buying more sustainable assets and selling less sustainable assets, or are you actively trying to change, I suppose, put the capex into the ones that you've got? What's the strategy there for you?
I mean, it's really dependent on the nature of the capital and whether that means you're buying new core buildings which are already answering that question in terms of their sustainability benefits that they're bringing to the building. Quite a lot of assets are tending to, or that we act on behalf of in terms of private equity, is looking at assets that require some work, just generally, and a large majority of that will be, that capex that we would be putting into the building purely on the sustainability piece. And that's for two reasons. One, it's what's going to attract the next purchaser, but also it helps to maintain the attractiveness to the tenant, either the one that's in there now or the one in the future.
Okay, good. I wanted to talk a little bit about, I guess, some of the subsectors of that between, bigger box, out of town, and the sort of more inner city urban logistics. Does one side have more growth potential than the other? I guess, how's anybody seeing that in terms of the opportunities at the moment?
Is it easier to underwrite something where there is pressure on land, i.e. urban environments? I think the answer is probably still yes. It depends on the geography as to where you are, because if we were talking about the Netherlands, in terms of big box locations in the Netherlands, it's pretty tight. So you could say the same argument for big box. But I think in simple terms, if you're in an urban environment, last mile and e-commerce, although it may be having its stuttering moments in some markets, there is a long-term trend of increase, and therefore, those supply chains are only ever going to get more intense, and the demand to get the goods to the customer is even greater, and therefore, and also for this just-in-case move that we're in now, rather than just in time, means we've got to be close to the customer. So I would think last mile is, if you were just differentiating between the two, is going to be greater.
I think that you're absolutely right on location, of course. And even if you took within the UK and you said, actually you look at new development and the impact of construction costs, and he said, okay, where does it stack up right now? And you might say, London, Birmingham, Manchester probably. But actually, when you look at the construction costs, making it an appraisal stack up in some of the other locations? That would be quite tough at the moment.
Absolutely right.
So more tricky. And Will, just from your point of view, I suppose, it would be interesting to get your perspective across Europe as well, in terms of what you're seeing there, the differences between some of those markets. There's some markets much more tight than others in terms of the potential to develop and.
Yeah, it's exactly the same. To the point you just touched on, Netherlands being one of them. There are geographies where land and planning regimes are challenging. There are others where actually land availability is there, but for whatever reason, they haven't progressed. So you're seeing those rental growths, but historically they've just been the opportunity to buy the land next door and build another location. But that, obviously, as the evolution goes, they're going to become more developed markets. UK obviously has its planning issues. Netherlands trying to deboxify, so limiting, it's going to be brownfields and more efficiency. You've got land ownership issues that you have in Spain and Italy with the volume of parties who have the controlled land. So buying a plot to build a big box, you've got 40, 50 people who you're trying to corral into agreeing a straight process, and then you've got the different municipalities that are trying to have their say on what employment base is there. So it really is night and day depending on the market you're looking at, and it varies massively. And it's fundamentally it's driving some of those markets, rightly so, in terms of not just allowing people to go and build anything everywhere. So
and do we think we're going to get a sort of pause in terms of development more generally? I mean, does it financially make sense to develop now, even to develop and hold?
I think it depends what the requirements are. For us, new builds need to be a certain standard, and fundamentally, I would hope that it's as efficient for us to build it as a third party, because fundamentally, someone's going to have to input the requirements we have for green buildings. So, and we have a demand for new space from our occupier business. So, for us, it's a case of making it work. And fundamentally, we've gone from a period of time where we were making probably too much in terms of development profit because of the lag in land pricing versus the acceleration of the investment market. You can still make developments work if the entry price on the land is right at a traditional 15-20% profit on cost scenario. So it's just that exceptional profit element has changed. The investor pool for core has got, instead of being 20 feet deep, it's now a few inches, but it's there is still capital there that need to be placing their returns into very green, very secure income. So it's just been repositioning. Fundamentally, the machine still works, and I think it's only a virtue of where land prices got to in some markets that you've had to pause and wait and see, and things have moved at different speeds. So in some markets, as we've seen, rental growth has been exponential. Others have lagged. Land prices in some markets have moved up and have stuck purely by virtue of the limited number of owners. So every situation has to be seen in isolation. You can't just have a blanket review. But fundamentally, things are working because the lack of supply means you need space. It means you have to make the cost work for our clients in terms of the rental, and the underwrites are working. They're just a little bit more cautious.
But you also have the volatility of the exit yields, which are the assumed position when you're going in to make it stack up. Yeah. I mean, Andrew, you showed across Europe, the differences, and actually you pick out, you go, oh, that's interesting, that one. But of course, those have been so volatile in the last few months, and they're stabilising, so you can actually find out, where your assumed exit yield should be.
Yeah, I think it really depends now how we see yields stabilise, because at the end of the day, for investors, certainty is one of the biggest things that they need to be able to make it through investment committees and justify that development. When we look at what we're seeing in terms of the occupier market, there will absolutely be appetite for a good product, especially those with strong ESG credentials. It's just got to, and the other thing as well is when we look at where we are in terms of vacancy rates, everything like that, if development slows down now, those developers who still continue to develop, once we come into an upswing in the economy, will suddenly be better placed and have those assets in place to obtain higher rents, to obtain better returns.
Exactly. And Andrew, do you think there is a real disconnect in terms of, because we're all expecting there to be an economic recession. And, if we'd have had this discussion again 5 years ago, you'd have gone, okay, well, e-commerce is the difference between logistics and other asset classes. Recession doesn't necessarily lead to there being an issue with the sector. But surely that's got to have some kind of impact at some level if you're, if there's a recession across Europe, really.
Yeah, I mean, inevitably, if we do see a recession, we will see a reduction in the flow of goods moving through the economy, which inevitably will have an impact on warehousing demand. And that's irrefutable, that's basic economics. At the same time, what we are seeing in the market is it's well placed in terms of fundamentals. Currently looking at economic forecasts, they aren't as negative as we would have seen sometime in, say, for the global financial crisis. And taking those into account, compared to other asset classes, the industrial market, or the logistics market is well placed to see out that economic turmoil.
Okay, good. It'd be interesting just to get your sense, Andy, maybe in terms of deals, what you're seeing at the moment in the market. I mean, you mentioned that there's still activity. Is there less competition for assets? Are we actually seeing people out of the market? What's your sense of that?
Yeah, as I said, I was going to be bringing Prophet of Joy before Christmas. Actually, as I said, I don't want to shout too loudly because I like to see these opportunities and be able to take them on behalf of clients. We're actually seeing a little bit of a bounce where there has been, and please don't put this in any headlines, but there have, because gazumping is a terrible word, but we have seen in the odd situation where there's been an agreement and then there's a realization that actually a discount in pricing at 30% from where it used to be actually felt a bit too much, and so we've seen that in the odd building, and we have lost out where we've been appraising opportunities where we thought we had carved the price sufficiently from where we might have been 3-6 months ago, and are missing out in a two-phase process of trying to purchase. So there is a market out there, and people are beginning to realise it. And I think I've encouraged our team pre-Christmas. Let's not celebrate too much because there's quite a lot that we can do now. But into the new year, when everybody wakes up, I hope they don't wake up too early because I've encouraged our team from January the 2nd to be on it.
Okay, interesting. And Andrew, do you? I suppose. Are you beginning to see more activity? Are you? What's your sense of that? And does logistics differ significantly to the other? I mean, because that's not necessarily what we're hearing in the other sectors, for example. I mean, so that's very interesting.
We're currently waiting to see what happens in Q4 in terms of our data. Especially when it comes to a pan-European, what we're looking for is we're looking to get feed in from our local teams and try and draw on that knowledge fully. We're definitely still seeing some large development, some large portfolios trading in Portugal in Q3. I think they saw record levels of investment. So there are deals happening. There is where the price is right, where the asset is there, and where vendors and buyers can find that common ground. It will be really interesting to see how that plays out once we start getting our data in Q4 and seeing where that trajectory is.
Okay, good. I wanted to pick up a little bit on some of the challenges, particularly, in terms of the sort of local government. There's never a very positive view in lots of the places I'm visiting in Europe, the Netherlands being one of those as well, Joost as well. Not to blame you for that, I point out. But in terms of people not really wanting logistics here, not wanting data centers here, not wanting those kinds of things. So I suppose, what's the position there? Do we see that changing? Do you think there's going to be a more favourable view, or do you think it'll actually get worse?
To be honest, I think in Holland there's a company called Interspace, or the old Somerset. What they are now trying to do with the last mile logistics is making more functions into the building. So Normally for logistics, you have only 1/3 of the roof you need it for the power generation, and for the rest you can use it for green farming, of urban farming, or playing fields, and build around houses or big shops. This is what we see now, and they do also a lot of research about what type of employees are working inside the logistics, and it's not low qualified employees, but how more and more techniques are coming in the distribution center. You need also higher skilled employees. So they are extremely busy trying to make it around, and I think more and more people will see that logistics are an essential part, just like in hospital. You need them, otherwise it's not functional anymore, because we live too much far away from where the food production is, for example. So we need it. And that point of view is maybe changing, because they are putting a lot of effort in the industry itself to also change the
Perception.
perception. Yes, sorry. Thank you.
But you can't apply too much logic to planning and regulation, though, can you?
But what you see is, on the end, much in Holland where I can only speak about is, on the end the local municipality also want to make money.
Yeah.
So this, on the end, if you have a good story and they can sell it against their words, what we were saying before, they are willing to move on.
It's interesting, you know, if you look at planning, which is sometimes to promote employment, and obviously relatively low unemployment rates, but if it is to promote employment, yet you've got automation, and if you've got a new greenfield site, if you like, that you're trying to get planning for, and you've got a heavy automation, which sometimes is, with these new facilities particularly, there you do have this dynamic between sort of its investment in a capital terms, but it's not creating the sort of employment uses which historically might have existed without that level of automation. That creates more of a tension.
I mean, that makes it quite challenging, because obviously a lot of the things, I mean, particularly, DHL focusing a lot on, I suppose, automation, but also lots of new technology going in. So I suppose, how do you play that, and particularly around that's because partially as well, that's that sort of social impact side in a way. So how do you work that out within DHL?
We haven't got anything that's fully automated yet. Functionally, we still have a reasonably large employee base in each of our buildings. It's not a challenge that we've had to overcome. We always go in and we talk, and we can articulate the employment headcount, etc., that we're going to provide to the areas. To be brutally honest, the bigger challenges we face are with transport. The increased flow of vehicles on existing road networks. That's where we get the biggest resistance, because a lot of the infrastructure set up in what is in newer locations isn't set up for HGVs, etc., and volume of HGVs travelling through them. So that's as big a challenge as it is the employment piece.
And in terms of things like electric vehicles, what are the plans there at DHL? What are the things that you're looking at in terms of future technology that may also therefore influence, I guess, what the real estate component needs to be delivering?
Yeah, that's quite a big question. A little bit of everything, really. We've got electric last mile delivery vehicles for our express business. We're looking at hydrogen vehicles. We've got electric planes. We're larger planes which run on greener fuels, buildings that are gasless, running on green electricity. Everything we can, we're trying to be front and centre of. And we have some very big innovation centres across the globe that are constantly looking to evolve all of our impacts, shall we say. And it is a constant moving target and a constant evolution. And there are a lot of people working towards solving it. But it is evolving constantly.
And in terms of vehicles, you'd be looking to have all electric vehicles?
I don't know what the target timeline has been set for it, but we're already exploring it. Part of it is functionality. range of some of the existing fleets and facilities. The other challenge we've touched on already is power and limitations and availability in certain locations. Having an electric fleet requires the ability to charge them in locations. And again, you throw that onto the no gas air source heat pumps, you throw that onto the automation, you've got a very hungry building, not quite on the lines of a data center, but it's moving toward that end of the spectrum rather than traditional manned warehouse. But it's going to be the case everywhere. This is not a DHL statistic. I remember reading an article that the current grids aren't set up for everyone to have electric cars.
No.
Functionally, it's not possible.
It's absolutely not possible.
So you'll know more about this than I will.
Yeah. No, I think the market is just starting in this, and ESG is also governance and especially social, where you also are. It's very important. We're talking now only about electrification, but what we see is at the moment, therefore we say it's very so keep it as simple as possible now. Only do the decarbonization for the creme, nothing more, because software is going in. We need to change our behavior. What we do a lot with our clients is saying, why you put this machine on at 8? Because you're using it at 2. Change your behavior is really a big advantage in changing the energy consumption and the ESG goals. And I think in the coming 5 years, the new Microsoft you have buildings management system, but the energy management system will become more important. Yeah. And that's just stepping up. So we are willing too much at this moment, sometimes I'm saying, keep it as simple, but has the side of investment and has the side in front of you where you're heading to.
Yeah, that's exactly right. It's not, we can't find the solution now. You can't build it and say, right, we're done. It's a constant progression, an evolution. So it's just something that needs to be monitored, progressed, and moved forward at all times, because technology is changing at a remarkable rate.
If you see in 1 year, we just put 500s, and now we are on 650s. It's watt peak or panels. It's changing so rapidly.
So I don't think we touched on it, did we? I mean, prop tech and its influence in actually how the buildings are used, how the supply chain is operated from start to finish. As Will just said, it is changing so rapidly, but technology must be part of the solution here.
No, I agree. Let's just. Does anybody have any questions? By the way, if so, I'm going to scan the room and Paul. Yes.
Interested to know whether everybody wants to put PV panels on the tops of their buildings and not only in the logistics sector. Is there, given that most of the PV panels come from China, are there price or supply problems even with PV panels that are going to hold up and obstruct people's ESG plans?
It's really different who you're working with. So there's a lot of low quality in the market. We call the 250, 355, 375 panels. They are bought 3-4 years ago. They are still in the market. If you are working like with Total or Engie or Shell, what we are doing, and they buy 2,000 containers every month directly, there is no problem in the supply chain. The real problem is that we are extremely behind as Europe in the production of PV panels. And so yes, we are completely dependent on China. And we are very lucky that we have at this moment still good shipments because of America. If America was not so hard putting the Chinese panels out, we didn't have any panel here. So yes, but for household panels, there is more than enough storage.
Okay, good. I just wanted to end on a sort of view around the particularly the investment side. So it'd be good to pick up, I think, key trends and what those mean for investment. Obviously, if you're not involved in investment, you don't need to do that. That's fine. You could just pick up on a key trend. So key trend, I suppose, for 2023 and where we think the investment opportunity is, and that can be either in, the type of building, or it can be that you think Let's say Italy is particularly good at the moment, so you can drill it down. Let's start at this end and work our way to that end. So, Chris, I suppose biggest trend and where you're seeing the opportunity, or where your clients are seeing the opportunity, whichever you prefer.
I'm going to sort of share a bit of Andy's optimism, I think, and say that I think there is. There will be the stabilising of seller and buyer expectations. I think that when one is going early into a market, that probably I would urge caution not in terms of going into the market, but caution in terms of how wild you get about location. So I think it's the core locations, and if the market is only just starting to trade, then the ability to get into those good locations, whether those are the urban centres that are showing the growth. I mentioned the ones in the UK and across Europe. Those sort of stabilised countries. Obviously, war in Europe doesn't help, and I think we all pray and hope that would end, and that would also create some other opportunities in other parts of Europe.
Great. Well,
I think it's the hopeful stabilisation or investor view as to where markets are going. There is potential for some distress in that because of the natural timing of people's investments in land and processes in buildings and the cost of debt shift that has been faced, and in some instances the inflationary pressures on products, building products. So for us, I think we're going to be seeing a full range of opportunities across every geography of people looking to either partner with us because we provide some solution, some land where the correction comes back, where we can look and have a future pipeline development, and existing buildings. There will be some investors who are under some sort of distress, and as we've touched on, it's still a very liquid asset class. So some of our existing footprint might be something that we can look to buy into, improve as we need to do, and then sell that onto the market again. But we need a little bit more core capital back there to basically work with the product that we create.
Okay, interesting. Yes.
Two things. I hope in an investment perspective that the typical beta approach, what is the conservative beta approach of IRRs or bars are stepping out of the market, because otherwise the problems we are facing are not solvable. And what I'm seeing is also a completely new investment market because of the regulations and the CRREM analysis. Buildings are going to be stranded faster than you think. And what I see now with our clients is that new typical investment brief 6 funds are stepping up, who are buying all those going to be stranded assets at lower prices, because mostly they are held in value add funds. So there is no money to invest to improve or pass the CRREM analysis. And what I'm hoping is that those brownfields are recreated in new type of logistic buildings or whatever. Yeah, I think that's the new trend coming in.
Okay, good, Andy.
And I think that'll be the case until land values allowing development comes through. And the longer that takes, then the more likely is that will happen. Geographically, just in terms of, again, let us hope it's sooner rather than later, but I think Poland and the Czech Republic will be interesting markets when the war in Ukraine comes to an end, in terms of being at the forefront of rebuilding that country. So I think there'll be opportunities there.
Okay, great. Andrew.
But in all seriousness, I think a lot of it now depends on interest rates and inflation. I think, when we look at the US, inflation looks to have peaked. When we look at the UK and when we look at the European markets, we're still seeing growing inflation, and that will inevitably see, if that continues, then central banks will have to adjust interest rates to meet that. From there, I thought it was interesting, was it this year, the Collins Word of the Year, permacrisis? We are in a period where we have consistently seen shocks to systems and that seems to be the case. And if that is what, it's very difficult to see what goes on into 2023. All things held equal, I think we'll see a kind of a reversion to what we saw in the past 5 years prior to the pandemic. I think that logistics will remain in demand. I think we will still see strong investment volumes into the sector. I don't think we'll reach those heady heights of 2020 and 2021, but that's purely just because we've come to the end of a decade of cheap capital. And now markets are now going to adjust to that. As we said throughout this entire period, we're in a period of price discovery, and when that shakes out, I think things will become a lot clearer.
Great, really interesting. Thanks very much for sharing all your views. Thanks very much for being here. If you're watching this on demand, thank you very much for watching. The next sessions that we've got are both online only, which are next week. One of them is looking specifically at the Italian market, and we'll pick up certainly some of the logistics sector there in terms of Garber's activity there. And then we've got one which is going to be looking at, on the crossover between infrastructure and real estate, which is going to look at new energy, sustainable energy. So some interesting ones there just before Christmas. Thanks very much for joining us, and if you could join me in thanking yourselves and the panel, that would be great. Thanks, everybody.